Well, news that S&P has put a negative outlook on the United States has left the financial markets in a state of flux. But our next guest says the markets shouldn't be surprised. They've known that the U.S. had serious fiscal problems for some time. Jonathan Lemco is senior sovereign credit analyst at the Vanguard Group, which has $1.6 trillion in assets under management. And Jonathan is joining us from his firm in Valley Forge, Pennsylvania. Jonathan, thanks for joining us to give us a little perspective on this whole situation. And indeed, we've really seen some differing reactions to this today. Why shouldn't folks be surprised that S&P is making this move when it is right now?
Because the United States debt and deficit load has been growing over time, and indeed that's a central reason why policymakers have been trying to focus on how to address the debt and the deficit. And the credit rating agencies, but notably S&P, sent out signals 2 months ago that they were thinking about taking an action of this kind as well. So this shouldn't be an enormous surprise. The U.S. does have fiscal problems. The trick now is how to best address those problems. And it's also worth mentioning that Moody's, their biggest rival, affirmed the credit rating of the United States less than 6 weeks ago. Fitch has been quiet, but my best guess is they might well affirm the U.S. too. So S&P is taking a negative outlook, not unlike what they did for the United Kingdom just about 2 months ago as well, in which they took this AAA and also put on a negative outlook. It's a way of signaling to policymakers we're paying attention right now. Now,
I'm curious, and this is sort of a sidebar, but I've seen some commentary today that has brushed off this action entirely and sort of hearkening back to the credit crisis, calling Standard & Poor's credibility into question on this. I mean, when you do your own sort of analysis of the U.S.'s AAA rating, what's your take? Is this action today justified?
First, I would stress this isn't an action. There's no downgrade here. This is a negative outlook. And so what S&P is saying is, look, we're going to spend the next 2 years examining very carefully the U.S. credit quality, and then there's a 1 in 3 chance that we're going to downgrade the U.S. from AAA to AA+. Still very high, but not the highest level. Is this justified? Look, given the serious debt and deficit issues of the United States, I think you can make the case that a negative outlook is justified, but probably under current circumstances, a downgrade is not. And the United States has certain really great strengths that tend to get ignored, particularly in the marketplace, which right now is just reacting with fear to all of this.
And what would those strengths be?
Well, the most diversified industrial-based and most diversified economic base in the world today by a long shot. The United States remains an almost $15 trillion economy. That's at least 2.5 times the size of the next country, if you will, in terms of wealth. The United States has a reasonably highly educated workforce. The United States has the world's most prominent reserve currency. All of these are tremendous advantages that nobody else does, and it's worth keeping in mind that productivity in this country, that is in the U.S., remains as strong, if not stronger, than virtually any other industrialized country at the present time. Labor mobility remains extraordinary by world standards. One could go on and on. So I'm not dismissing the fiscal problems of the U.S. They're serious. They have to be addressed. But let's not forget as well the underlying strengths that led the United States to a AAA status. And that's really key in all of this.
Well, when we talk about the risk, though, I mean, in your view, if Congress does not come to some sort of agreement and you do see the debt to GDP continue to climb, as Standard & Poor's says it could, to about 84% by 2013, what is the biggest sort of fallout risk from that happening to the U.S. economy?
In the event that the fiscal situation continues to deteriorate, then again, a 1 in 3 chance that the United States gets downgraded. If that happens, and I would stress to you that I think it's unlikely, but if it were to happen, then the U.S. borrowing costs would go up to a certain degree as well. there's no reason to believe that it's not even worth talking about the United States as having default risk. The United States will still be one of the most solid credits in the world today, but in the event of a one-notch downgrade, it will be a AA+. It's still extremely high, just not the highest level. There'd be a cost in terms of borrowing costs, therefore, a cost to the U.S. in terms of prestige as well. U.S. and Americans in general take real pride in the fact that this is a strong AAA credit, as we call it, in the world today, one of the most creditworthy countries in the world. So there's a prestige issue, too, that I don't think should be dismissed. Also, there's some U.S. government-owned agencies that would likely see their credit rating downgraded from AAA to also AA+, thereby increasing their borrowing costs, too. So the costs to the U.S. are not insignificant, both in terms of financial cost, but also in terms of psychological or prestige-related costs. It's not the end of the world, but it would certainly hurt. But that said, I would stress S&P's not doing this anytime soon, and they may not do it at all. In fact, the likelihood is they won't. It's sort of a kick in the rear end to policymakers now that they have to get their act together and reach a reasonable compromise that will allay the concerns of the ratings agencies, and even more important than the agencies, allay the concerns of the broader market.
Jonathan, quickly here, I'm just curious, I mean, do you think that this S&P outlook is enough to tip the scales in Washington?
No, I think it's one signal. And a credit rating agency report in and of itself has some impact. Today, it's all the news. Tomorrow, we'll move on to something else. It matters, but there are other important factors as well that policymakers will be looking at, other inputs that they'll be looking at as they make decisions about how to address the fiscal problems, issues related to industrial growth, issues related to the employment or unemployment rate. All of these things are far more important than whether S&P does or does not change the outlook on the United States and in a couple of years maybe take the credit down. It's just one tool or one input that you take seriously, but it's one of many such tools.
Jonathan, thank you so much for your time and giving us a little insight into this whole situation. Jonathan Lemco is a senior sovereign credit analyst at the Vanguard Group.